There's a stock trading right now that, according to 17 Wall Street analysts, 3 hedge fund managers, and approximately 4,000 Reddit posts, is about to explode. The catalysts are lined up. The chart pattern is perfect. The fundamentals are screaming. And if you don't get in before Thursday's earnings call, you'll have missed the opportunity of the decade. Except here's what nobody's telling you. The stock has already exploded 3 times. And each time, the people who bought because they heard it was about to explode got destroyed. Not because they were wrong about the company, because they were thinking about explosions completely backwards. I'm not going to tell you which stock to buy. That's not how this works. But I am going to show you exactly how a stock that's supposedly ready to explode actually behaves, why the language itself is a trap, and what the people who consistently profit from explosive moves understand that everyone else misses. By the end of this, you'll know more about market mechanics than most retail investors learn in a decade, and you'll understand why the question isn't which stock is ready to explode. It's whether you're positioned to survive the explosion without getting burned. Let's start with what explosion actually means in stock market terms. When people say a stock is ready to explode, they mean one of 2 things. Either the stock is going to make a massive move upward in a very short time frame, or it's trading at a price that doesn't reflect some coming catalyst that will force the market to revalue it higher. The first definition is about momentum. The second is about information asymmetry. Both sound great. Both are extremely dangerous if you don't understand what you're actually buying into. Take momentum first. A stock that explodes upward typically does so because of a technical setup where buying pressure overwhelms selling pressure in a short window. Maybe it breaks through a resistance level that triggers algorithmic buying. Maybe short sellers are forced to cover their positions, creating a squeeze. Maybe retail investors pile in all at once after seeing a trend on social media. The move can be 15, 30, 50% in days or even hours. It looks like free money. And for the people who got in early, it is. But here's the thing about explosions. They're violent, unpredictable, and they leave debris everywhere. The stock that goes up 50% in 3 days can drop 40% in the next 2. Not because the company fundamentally changed, because the momentum trade exhausted itself. The people who bought at the top, convinced they were still early, are now holding bags while the early movers already exited. This happens over and over with the same stocks following the same pattern. And every time, a new wave of investors convinces themselves this time is different. The information asymmetry version is subtler but equally problematic. This is when a stock is supposedly undervalued because the market hasn't priced in some coming development. Maybe it's a pending FDI approval. Maybe it's an earnings beat that Wall Street isn't expecting. Maybe it's a strategic partnership that hasn't been announced yet. The thesis is that you, armed with research or insight, can get in before the crowd realizes what's happening. And when the catalyst hits, the stock explodes as everyone else rushes in. This actually works sometimes. But here's what they don't tell you. By the time you've heard about the catalyst, by the time it's being discussed in trading forums or mentioned by analysts, by the time you're confident enough to put real money into it, the smart money has already positioned. The explosion you're anticipating already happened in the options market, in pre-market trading, in dark pools, where institutional investors move size without moving price. You're not early, you're late. And the explosion you're buying into is actually the top. Let me show you how this plays out with a real pattern that repeats constantly. Small cap biotech company. Phase 3 trial results coming in 60 days. The drug looks promising. The stock is trading at $8. You do the research. You're convinced that if the trial succeeds, this stock goes to $20 or $30. You buy. You wait. The trial results come out. They're positive. The stock gaps up at the open to $15. You're thrilled. You were right. Except the stock closes that day at $11. The next day, it's at 10. Within a week, it's back to 8. What happened? What happened is that the move from 8 to 15 wasn't the beginning of the explosion. It was the end. The people who were going to buy on positive trial results already bought weeks ago when the stock was at 6 or 7. They bought the rumor. When the news hit, they sold. You bought the news. You became their exit liquidity. The stock didn't fail to explode. It exploded while you were watching from the outside, and by the time you got in, the explosion was over. This is why the language of stocks ready to explode is so dangerous. It creates the illusion that the opportunity is in front of you when it's actually already behind you. The stock doesn't care about your timing. The stock doesn't wait for you to be ready. The explosion happens when the conditions are right, and those conditions are usually set up weeks or months before the catalyst everyone's watching for. Now, there are people who consistently profit from explosive stock moves. They're not psychic. They're not smarter. They're doing something fundamentally different from what most retail investors do. They're not looking for stocks that are about to explode. They're looking for stocks where the setup for an explosion exists, but nobody's paying attention yet. They're buying before the catalyst is obvious. They're buying when it's uncomfortable, when the stock is boring, when nobody's talking about it. And they're selling when everyone else is buying, when the explosion everyone was waiting for finally arrives. This requires a completely different mindset. You're not trying to catch the move. You're trying to position before the move is visible. That means buying things that might not work out. That means holding through periods when nothing happens. That means exiting when your thesis plays out, even if the stock looks like it could keep going. It's the opposite of how explosion hunting typically works, where you wait for confirmation, then jump in, then hope you're not too late. The other group that profits are the people who don't play this game at all. They ignore the explosions. They buy broad diversification. They hold for decades. They let compound interest do the work. This sounds boring compared to catching a stock that goes up 50% in a week. But here's the math. A stock that goes up 50% in a week and then crashes 40% is now only up 4% from where it started. A diversified portfolio that goes up 10% per year, compounded over 10 years, doubles your money with far less stress and far less risk of catastrophic loss. But nobody wants to hear that. Nobody wants to be told that the smart play is to be boring. The explosion narrative is too compelling. It promises transformation. It promises that you can turn a small stake into life-changing money if you just pick the right stock at the right time. And occasionally, someone does exactly that. They put $5,000 into something that becomes $50,000. They post their gains. They become the proof that it's possible. What you don't see are the 100 people who tried the same trade and lost everything. What you don't see is that same person's next 10 trades that all failed. You see the explosion. You don't see the graveyard. So here's the actual answer to which stock is ready to explode. All of them and none of them. Every stock in the market is one catalyst away from a massive move. Every stock is also one disappointing quarter away from a collapse. The difference between a stock that explodes upward and one that explodes downward isn't always fundamentals. It's sentiment, timing, positioning, and luck. The people who tell you they've identified the one stock that's ready to go are either selling you something or they're confusing a thesis with a certainty. If you want to play the explosion game, understand that you're gambling, not investing. Gambling. Maybe you'll win. Probably you won't. The house edge in this game is institutional investors with better information, faster execution, and more capital than you'll ever have. Your edge, if you have one, is patience and discipline. Buying before it's obvious, selling when it is. Sizing positions small enough that being wrong doesn't wipe you out. Or you could accept that explosions are entertainment, not strategy. That the real wealth building happens slowly, through compounding, through diversification, through not losing money on stupid bets. That's not exciting. It won't make for a good story, but it works consistently, predictably, boringly. The stock that's ready to explode is the same one that's always ready to explode. The one nobody's talking about yet. The one that hasn't moved. The one where the setup is there, but the catalyst hasn't been identified. And by the time you've identified it, by the time it's ready in the way everyone means when they say that word, you're already too late. The question isn't which stock. The question is whether you're willing to accept that explosive returns require explosive risk, and whether you're prepared for what happens when the explosion goes the wrong direction.